All right, now for the most part, the market gyrating a little bit today. It's fine. Investors are grappling with the classic problem. Ride the winners, keep riding them out, cash in and wait, or buy the losers because, the law of averages plainly states that chances go around. Well, here is Mahoney Asset Management President Ken Mahoney. And Ken, you say stick with the winners. You like the semiconductor ETF, the Qs, the triple Qs, and I think you also have exposure to names like Tesla via the ARKK. Stick with those winners for right now?
Right now, look, I think it's a value trap. It's kind of getting caught in quicksand. We get good news. I hate to throw a wet blanket on the news over the weekend about the plasma, therapeutic. But every time we go there, you start seeing airlines, you start seeing cruises catch a bid. And to me, I'd rather be in a leadership. The opportunity cost of missing this, it's like a good basketball team. Every day someone steps up. One day it's Tesla, one day it's Apple, today it's Facebook, today it's also Alibaba. I think we saw Microsoft move up a little bit today. But you really got to stay with the technology, you got to stay with the leaders. And if you're uncomfortable, you can look at, let's say, the 100-day moving average or the 20-day moving average and put a stop loss below it. But this trend's been really, really strong. And I really think you're wasting a lot of time and a lot of money sitting waiting for these value names to turn around.
It's ironic, too. This is the conundrum that every time value starts to move, if it comes at the expense of growth stocks, which, of course, is so heavily powerful in these indexes, and the indexes come down, then the money goes back into growth because they're not just seen as growth these days. They're also seen as the new safe havens, aren't they?
And look, these moves you've seen from value to growth, growth to value. The growth to value move lasts about 2 days, pretty ephemeral, and then we're back to basics. We're back to you might as well just stay with the leaders. It's not working. Look, you take a look at banks as an example. Their multiples are contracting. You want to be in an industry that are expanding. I mean, look at Apple. Apple for many years traded at 12 or 13 multiple, and now here it is, just taking up steam. So, everybody makes the argument, oh, look how cheap it is, look how cheap it is, and you find in banks, it's just one area where it's contracting. And then you look at Warren Buffett, the ultimate value investor, checking out of banks. So again, I don't want to be in value, particularly banks for that matter.
I'm glad you brought all of those things up because people are taught to invest by the numbers and you go for these low PEs or stocks that are out of favor, but they're that way for a reason. We got a minute and a half to go, and I want to talk about two ideas you like a lot. BMEZ is, I think, is an ETF along with QDEL, both sort of in that medical field. What do you like about them?
Yeah, so if you want some exposure outside of technology, BMEZ is an ETF that trades 8% below discount, pays a 5% yield, and get this, 20% of the portfolio is in privates. Again, it's hard for individual retail investors that are not accredited investors to get that type of piece. QDEL, by the way, you probably know them if you go in for influenza season with the rapid test that lets you know right away. They got FDA approval. Now they're doing COVID-19. I can imagine what they're doing here. About 2 million tests a day, $20 a test. Stocks come way, way down because these therapeutics are coming out, but we're still going to need testing, guys. I see $15 a share in the stock roughly. Give it a 20 multiple, and it goes back to the year high, $300 a share. So you got to like QDEL. Unfortunately, the influenza season's coming up again, and that's where they really have a stronghold on.
These testing stocks have done extraordinarily well. Ken, you gave us two winners. All right, buddy, appreciate it. Thank you very much. And we're